Massey is only listed on the JSE and TTSE.
Okay.
And for me, if I was considering to move shares to Trinidad to make some money, I'd do it probably to go to Carnival, make some money in Jamaica, transfer the shares on Trinidad, so I have some TTD to spend on there. It's money makes
Yes, sir.
monetary sense. But let's get into the meat of the matter, and in this case, it being NCB Financial Group. So we saw on Friday disclosure that, come this Friday, November 17, that NCB Financial Group is intending to consider a dividend payment, to shareholders. And this will be the first dividend payment since May 2021, if this dividend actually does go through. This is a very symbolic dividend, just before the company considers a APO, bringing it to market. And it's pretty interesting to see, what will come about in the coming days, regarding that dividend. But on the flip side, what also to consider is the fact that there's another disclosure that came out yesterday that highlighted that Patrick Hilton and Dennis Cohen, have resigned as directors and officers of NCB Financial Group and its subsidiaries. And, their separation package alone is, material to NCB Financial Group's, fourth quarter performance. And for context, people, NCB Financial Group has a $2 trillion asset base on their balance sheet. They made $7.39 billion consolidated profit last quarter, which should have been June 30, $5.48 billion in attributable to shareholders. So, but it's a material impact. You're talking about a couple $1 billion as well. So let us see, what does come about with that. And I'm guessing, I'm not going to slightly see a dollar dividend. Probably lucky if we get a 50-cent dividend, which would have been the last payment that we saw back in May 2021. But let's see what, Lee Chin has in mind for shareholders ahead of Christmas. And then the other item on hand, which we are discussing tonight, is VMIL Investments Limited. And in this case, being its subsidiary VM Wealth Limited. So VMIL, which is a listed company, owns VM Wealth Limited, which is its subsidiary. And in their most recent released report, they're highlighting that VM Financial Group will be, issued non-redeemable, non-cumulative preference shares in VM Wealth, and VM Wealth will receive $1.5 billion in fresh capital, to further bolster its capital adequacy. So what does that mean? So just like banks, financial institutions such as brokers, for example, or as they would be termed, securities dealers, are required to actually follow through with having certain ratios in place. So in the case of securities dealers and banks, the minimum requirement from a regulatory standpoint is 10%. So in the case of VM Wealth, they say that this increase should actually push it from 18% to 24%, which is almost 2 times the actual minimum regulatory requirement. And this, injection into VM Wealth, is coming at a time when, you're seeing reduced fee income for, VM Wealth and in turn VMIL. You're seeing high interest expense, so the margins are smaller there. You're seeing, relatively higher costs, albeit, some level of containment in other areas. So this new round of this capital injection into VM Wealth, it's unexpected, and it's a good thing because we've seen with NCB Financial Group with NCBJ, JMB Group with JMB Bank, Scotia Bank, Jamaica with Scotia Life, JN Financial Group with different financial subsidiaries, that we've just seen continuous, capital injections into different financial subsidiaries where, financial companies, as different companies incur fair value losses, which impacts their capital ratios and so forth. And so for VMIL, whereas the quarter was relatively stable, and they saw an increase in profitability, which should have been assisted by its associates in Kingston Properties Limited, for the overall 9 months, it was net profit was down 44%. And a big part of that was just the cut in interest income and fees and commission income as well. But the reality is the party must go on, and we're likely to see or hear different developments in the financial sector as time goes on. One last thing to note, so with respect to preference shares, to oversimplify, they're similar to like regulated instruments, just rank just above ordinary shareholders, and there's ways to make money off them. And one simple way is to actually buy it at a discounted price relative to maturity price. So for example, last cut a preference share at $1.74, and maturity price is $2, and this preference share gives 9.9% dividend rate for the year, or it's the interest rate I should say. So this is just giving a simple overview of how persons can take money off preference shares and get what you call a higher, more stable return in this environment where you're seeing reduced market activity in the stock market and other areas. Condolences to Kalila, on the recent developments, and I look forward to seeing you guys in another 2 weeks. Go to those quarterly reports, and I'll see you around.